Imagine waking up to like this massive headline that your hometown just won a record-breaking lottery.
Oh, that'd be nice.
Right. But then you check your own bank account and you realize you can't even afford a celebratory dinner.
Yeah, the math just doesn't add up.
Exactly. And that is the exact paradox we're unpacking today. Welcome to the deep dive.
Glad to be here.
So today we're looking at some excerpts from The Great American Wealth Gap and the Millionaire Boom, which actually unpacks all this wild data from the UBS Global Wealth Report 2026.
Yeah, the numbers in this report are, well, they're pretty staggering.
Staggering is the word, because according to this, the United States minted over 1,200 new millionaires every single day in 2025.
Every single day?
Right. But, and here's the catch for you listening at home, if you look closely at the data, the actual wealth of the typical American fell over the past 5 years.
Yeah, it actually dropped.
Okay, let's unpack this. Because it's literally like that lottery analogy, right?
Yeah.
Your town is supposedly booming, but your wallet feels lighter than ever.
Totally. And, my goal today is really to ground this conversation. We have to look past these top-line numbers. A headline that just screams, millionaire boom, is, well, it's designed to grab your attention.
Right, it's clickbait.
Exactly.
Huh.
But it totally obscures the actual mechanics of modern wealth.
Yeah.
We need to look at how this wealth is generated and who actually has the structural capacity to, capture it.
Because the economy isn't just one single reality that we all share.
No, not at all. And 2025 proved that more than, honestly, any other year on record.
Yeah, so to really grasp what's happening in this completely bifurcated economy, we need to talk about the sheer scale of wealth at the very top.
Let's do.
Because the UBS 2025 numbers are, they're hard to process. In just 1 year, the U.S. added more than 441,000 new millionaires.
Which is just a massive surge.
Yeah, and that brings the total number of millionaires in the U.S. to roughly 23.6 million people.
Right. And to really put that into a global perspective, it reveals the gravity of the concentration.
Yeah.
The U.S. now houses over 40% of the world's total millionaires.
Wait, 40%?
Yeah, almost half. If you tally up all the newly minted millionaires across the entire globe last year, the U.S. claimed about half of them.
That is insane.
And the contrast is just stark. So the U.S. added 441,000. Do you know what the runner-up was?
I don't know, maybe China?
Nope, the U.K. And they gained about 43,000.
Wow. Okay, so that's not even in the same stratosphere.
Not at all. It's a tenth. And then following the UK, you have like France, Spain, Japan, and India, and they each added over 30,000.
Okay.
Though, to be fair, for the first time, all 56 markets that UBS tracks actually ended the year with more millionaires than they started with.
But the U.S. is just totally running away with it.
Exactly. And the extreme top, it accelerated even faster. Globally, we now have 3,302 billionaires.
Jeez.
Yeah, which is a 13% increase in just 1 year. And over 1,000 of those billionaires reside in the U.S. Their collective wealth rose by nearly 25%.
Just massive gains.
Right. And if you look just below that, the tier of adults worth between, say, $5 million and $100 million. There are about 7 million of those individuals globally. And more than 4 million of them live right here in the United States.
Okay, wait, I need to jump in here because I'm looking at the data and there's this weird contradiction.
Okay, let's hear it.
So total wealth in Europe and the Middle East apparently jumped by 18%.
Right.
But the Americas only saw an 8.5% growth.
Yeah, that catches a lot of people off guard.
So on paper, it looks like Europe is drastically outperforming us in wealth generation. But knowing how these reports are made, I suspect this has more to do with currency exchange rates than actual economic booms in Europe.
That is a really sharp observation. And honestly, what's fascinating here is the absolute necessity of understanding the exchange rate caveat.
Okay, lay it on me.
When an organization like UBS compiles a global report, they need a baseline, right, to compare apples to apples.
So they use the U.S. dollar?
Exactly. They measure everything in U.S. dollars. But global currencies are constantly fluctuating. Last year, the U.S. dollar actually fell relative to several major currencies. And the euro appreciated by about 9%.
Ah. So, wait, that means the actual wealth of a European household didn't necessarily change for them?
Not in their day-to-day lives, no.
Like, if a family in France owns a home worth €1 million and their wages stayed the same, they aren't actually richer when they go to the grocery store.
Nope. Their local purchasing power is exactly the same.
But when UBS converts that €1 million into dollars for their spreadsheet, that family suddenly looks 9% richer to the rest of the world.
Yep. Just because the euro strengthened, that currency shift, basically artificially inflated European wealth on paper.
Wow.
Yeah, so a lot of those huge 18% statistical wealth increases in Europe and the Middle East, they're mostly reflecting exchange rates, not newly generated economic output.
Their factories weren't suddenly producing 18% more value,
Exactly. Their currency was just trading at a premium.
which totally flips the narrative when we look back at the United States,
Right.
because the U.S. didn't get any kind of statistical lift from exchange rates since we already used the baseline currency.
Yep, no spreadsheet tricks for the U.S.
Which means those 441,000 new American millionaires, they were generated by real, actual domestic asset growth.
And that is the dividing line in the data right there. All 56 markets gained millionaires, but the reasons why were fundamentally different.
Europe had a currency quirk.
Yeah, and the U.S. had actual domestic asset appreciation. The nominal value of assets held by Americans genuinely expanded.
Okay, so if this American boom is from real asset growth, we have to figure out where that money actually went.
We do.
Because why aren't you, the listener, feeling it? And this brings us to what I think is the most jarring contradiction in this whole deep dive.
The averages versus the medians.
Yes, when you measure average wealth per adult, the United States ranks second in the world, just behind Switzerland.
Which sounds amazing.
It sounds incredible,
Right.
but when you switch that metric to the median wealth per U.S. adult, the country plummets to 28th in the world, hovering at about $69,000.
Yeah, that gap from second down to 28th, that is really the defining feature of the modern American economy.
It's terrifying.
And it's crucial to understand that median wealth actually fell across most of the country's tract last year, even as their averages kept climbing.
It's just the ultimate distortion of averages. Like,
Oh.
imagine a billionaire walks into a crowded local coffee shop.
Okay, I'm picturing it.
Suddenly, the average wealth of everyone in that room shoots up to hundreds of millions of dollars.
Right, technically true.
And the headline the next day says, "Coffee shop patrons experience unprecedented wealth boom."
Yeah.
But the median, the person standing right in the middle of the line waiting for their latte, they still only have $50 to their name.
Yeah, exactly.
The average is totally hijacked by that extreme outlier. It tells you nothing about the actual people drinking the coffee.
Well, if we connect this to the bigger picture, that coffee shop scenario is basically playing out across the entire U.S. macroeconomic landscape right now. The millionaire boom tells you absolutely nothing about the typical household, because that massive average figure is just a reflection of how incredibly heavy the very top of the wealth pyramid has become.
Because those top few hold so much.
Right. The median, which is the exact midpoint of the population, that is your true signal of societal prosperity.
And a median wealth of $69,000 is a huge warning signal.
A glaring one.
I mean, that figure includes everything. Your savings, your car, your emergency fund, any little bit of equity in a home.
Yep. Everything you own minus your debts.
In an era of high inflation, $69,000 offers almost zero breathing room.
Not at all. There's actually a great quote in the UBS report from their chief economist, Paul Donovan. He states that people tend to think about their wealth relative to the wealth of others.
Oh, that makes so much sense.
Right. It totally highlights the psychological toll of this gap. When the media is constantly broadcasting record economic highs,
The market is booming.
yeah, it breeds this deep sense of alienation for the median earner. You're constantly being told the economy is doing great, but your actual lived experience is stagnant wages and, shrinking purchasing power.
Which is exactly why you might look at your 401k and feel like, okay, I'm participating in this boom. But then you go to the grocery store and you realize your paycheck hasn't kept pace with the asset inflation that drove your 401k up in the first place.
Exactly. It creates intense friction.
So knowing that the median American is stuck at that $69,000 mark, we have to really look under the hood here.
Let's do it.
What specific machinery is creating 1,200 millionaires a day while leaving the middle class completely in the dust?
Well, the answer really lies in asset allocation.
Okay.
The UBS report breaks down where American wealth is actually parked, and it is highly specific. Nearly 79%, so about 4/5 of U.S. personal wealth, is held in financial assets.
4/5? Wow.
Yeah, we're talking stocks, corporate equities, mutual funds, retirement accounts, brokerage holdings.
Which is a massive concentration compared to the rest of the world.
Huge. It's among the highest shares of financial asset concentration of any market that UBS tracks. U.S. wealth is uniquely, deeply tethered to financial markets.
Okay, I see where this is going.
Right. So when we analyze the wealth generation of 2025, we're essentially just analyzing the stock market.
And 2025 was a great year for stocks.
It was a remarkably strong year. And because financial assets compound, those massive market gains naturally flowed almost exclusively to the people who already held the wealth to begin with.
Here's where it gets really interesting, because I think people misunderstand how this wealth is created.
How so?
Well, this isn't wealth created by, like, an explosion of new factories, or some massive surge in manufacturing, or companies doubling everyone's wages.
No, that makes
It's
sense.
largely asset price inflation. The market goes up, the multiples on earnings expand, and the people holding the shares just see their net worth skyrocket on the spreadsheet.
Yep.
But if you don't own those assets to begin with, you are entirely locked out.
That distinction between fundamental economic expansion and asset price inflation is so vital.
Right.
When capital aggressively seeks returns, it bids up the price of existing assets. The actual intrinsic utility of a share of stock or a piece of real estate, for that matter, hasn't necessarily doubled.
The house is still the exact same house.
Exactly. But the nominal price attached to it has doubled. This benefits the investor class exponentially, but it does absolutely nothing for a worker who relies solely on an hourly wage.
And we see this exact dynamic with housing, too.
Oh, heavily.
The report details how rising home values are pushing everyday homeowners past the million-dollar net worth line purely on paper.
Right, without adding a single cent to their actual paycheck.
Right. If anything, their cash flow decreases because their property taxes and insurance premiums go up as the house appreciates.
Which introduces the whole concept of liquidity, or really, the lack of it.
Yeah.
A primary driver of this new millionaire class is just the fact that a house bought 20 years ago has tripled in assessed value. But that wealth is literally trapped in drywall and timber.
You can't spend drywall at the supermarket.
Exactly. A median homeowner cannot easily pay for a medical emergency with the unrealized equity in their primary residence. Not unless they're willing to sell their home and re-enter a hyperinflated housing market.
Right. Unless, of course, you are wealthy enough to utilize collateralized borrowing.
Yes.
Because this is the mechanism that truly separates the top tier from the median. If you have $10 million in a stock portfolio, you don't have to sell your stock and pay capital gains taxes just to buy a yacht or fund your lifestyle.
Nope, you just go to a bank.
Exactly. You use your inflated stock portfolio as collateral, and you take out a line of credit at a super low interest rate.
Yep.
So they get to use their paper wealth in the real world without ever realizing the taxable gain.
You've identified the core mechanic of modern extreme wealth right there. The ability to borrow against appreciating assets is almost entirely reserved for the top of the pyramid.
It's wild.
Think about a household with that $69,000 net worth. Most of that is tied up in a depreciating asset like a used car or a modest emergency fund.
You can't take out a low-interest credit line against a 2015 Honda Civic.
Exactly. They cannot utilize collateralized borrowing. They have to pay for their lives with fully taxed, stagnant wages.
So the asset class lives on untaxed borrowed liquidity backed by paper gains,
Yeah.
and the working class lives on highly taxed, inflation-eroded wages.
That is the reality.
And there's another massive structural bias in this report regarding who is considered wealthy.
The pension issue.
Yes. The UBS methodology explicitly counts financial assets plus property minus debt, and they include private pensions, like a 401k,
Right.
but they intentionally exclude state pensions. Social Security is completely erased from this wealth calculation.
Well, this raises an important question about the philosophical definition of wealth.
How do they justify excluding it?
Because from a strict accounting perspective, Social Security is an unfunded liability of the state. It's a promise of future cash flow, not a tangible asset that you can sell, borrow against, or leave to your children.
Okay, sure. Accountants might see it that way. But for the vast majority of the working class, Social Security is the absolute bedrock of their financial security.
Oh, absolutely.
By excluding it, the report essentially zeroes out the primary retirement vehicle for millions of people. It further skews the perception of who actually holds wealth.
It does.
I mean, if 80% of our national wealth is tied to volatile stock market performance and housing prices, and we aren't even factoring in guaranteed safety nets like Social Security, this entire boom looks incredibly fragile.
The fragility is the unspoken undercurrent of this entire data set.
It has to be.
Because the U.S. wealth profile is so intensely leveraged against financial markets, a market correction doesn't just erase numbers on a screen. It fundamentally alters the national wealth ranking.
Wow.
When a boo is built on asset price inflation rather than, broad-based wage growth or infrastructural development, it inherently lacks a stable foundation,
It's a house of cards.
essentially. It just means the ledger of the investor class expanded during a favorable market cycle.
Which explains exactly why the median wealth actually fell. The middle class, who relies on wages rather than stock portfolios, basically spent the last 5 years fighting inflation. The cost of food, energy, basic necessities, they all outpaced paychecks.
Which forces people to dip into their savings.
Exactly, or accumulate credit card debt just to maintain their baseline standard of living. Meanwhile, the top tier is just riding this frictionless wave of asset appreciation.
It is the ultimate manifestation of a two-track economy. We are looking at two entirely different economic models, one based on labor and one based on capital appreciation, operating simultaneously in the exact same geographic space.
Yeah, and this is why, for you listening, when you see the financial media celebrating a national wealth boom, you have to run it through the filter of your own reality.
You really do.
The secret to understanding this data lies in that massive canyon between the $69,000 median reality and that asset-heavy average skewed by a booming stock market.
And that requires a massive shift in how we consume economic news. National averages are no longer reliable indicators of collective well-being.
Not at all.
They are purely indicators of top-tier asset performance.
Right. So the ultimate takeaway here, the so what for you the next time you see one of these sweeping economic headlines, is to immediately stop and ask the right question.
Always ask the question.
Ask yourself, wait, am I looking at the reality of the median coffee shop patron, or am I just looking at the math warped by the billionaire who just walked in the door? Understanding the difference between asset inflation and actual wage growth is the key to protecting your own financial perspective.
That is the essential critical lens. And as we wrap up this analysis, I actually want to leave you with a final lingering thought to explore on your own.
Lay it on us.
Given that reports like UBS define wealth almost exclusively by highly volatile financial assets and real estate, while totally ignoring the fundamental safety nets of the working class like Social Security, what does it truly mean to be a millionaire in the modern economy?
That's a great question.
If the stock market experiences a severe correction, or if the housing market suddenly cools under the weight of higher interest rates, are millions of these newly minted millionaires just one bad fiscal quarter away from falling right back down the pyramid?
Wow.
It forces us to ask whether modern wealth represents actual lasting financial security, or if it is just a temporary state of the market.
A temporary state of the market. When your wealth is built entirely on the fluctuating opinions of financial markets rather than tangible production, the ground beneath you is always shifting.
Always.
Thank you so much for joining us on this deep dive into the real mechanics of the millionaire boom. We'll see you next time.